Hello, everyone, and a very warm welcome to today's major markets update for Thursday, April the 4th, 2024. We didn't do a video update yesterday because nothing had been resolved, and I won't be able to give an update tomorrow, so I'll give an update today instead via video, because today the Fed giveth, the Fed taketh away. Namely, one of the Feds said today that we may not see a rate cut this year. Well. We wait for the other shoe to drop. That's what I tweeted or X'd a couple of hours ago, that we might not see this anticipated rate cut. Why? Already March 12th, I said, it is my opinion for a while that there will be no rate cuts in 2024. And I'll eat crow, and I'll take a picture of it. It might not be a real crow. How about a cake crow? That is not going to happen. Why? Well, look at what oil did today. Look at what oil has been doing today. Look at what gold, silver have been doing today. Inflation comes in many flavors. And if oil goes up, essentially everything else goes up. As Powell said in his March last year's testimony to, I believe, Congress, for every $20 that's added to a barrel of oil, inflation will go up 0.2 or 0.4%, and GDP will drop by 0.1%. And it's starting to look pretty nasty out there from that perspective. Oil is up $20, $30, not almost $40 since its lows. So there goes your inflation. That's still my humble opinion, okay? And if I'm wrong, I'm wrong. I know you can't trade the market on opinions, but the first shoe has dropped, and we'll wait for the next shoe to drop. What is that? More inflation. Interestingly, my wife is in the market to buy a new car. Unfortunately, she's been in an accident, and she's fine. Just material damage. Her car totaled at 15 miles per hour, believe it or not. Regardless, the cars are sitting on the parking lot, the dealer told us. Everybody is waiting for lower interest rates. Now, I personally don't know if 0.25% or 0.5% on your interest rate is going to do you anything on your car payments, but I cannot look in somebody else's wallet. But I find it really interesting. People are really waiting for a 0.25% drop in your car payment interest rate. It's not going to make a drop in the bucket, in my humble opinion. But maybe all these people are shopping in a car class that is way above ours, and on hundreds of thousands of dollars, 0.25% will make a difference. But I don't think so. That's just me, and I think people can wait a long time. Meanwhile, we have a nice Beamer to look at today, and hopefully my wife's going to buy it because I'm pretty tired of her Chevy Malibu rental. What a POS. Anyway, long story short, first shoe has dropped. We're going to wait for the second shoe. If we don't see any interest rates, if interest rates are going up, the market is completely going to crater. Just the mentioning of it already caused it. Now, I'm happy I didn't send out a written update for the Thursdays that I normally do. And as you can see, here's all the charts you're going to get. I know it's a lot because we're going to go over a lot. But about 2.5 hours ago, I saved already the chart for the PMO buy sell all indicator for the S&P 500 McClellan oscillator and for the S&P's summation index. Why? To show that it's been a horrible market from these indicator perspectives. So I did that just before the market started to crash. This is at 11:08 Pacific Standard Time. So that's about 2 o'clock Eastern Time. And let's have a look at what the market then did. All right. So what did the market do? As you can see, the last 2 hours. So this is where I saved the charts. And everything looked pretty okay, still for a potential upside. And this is what we got. The Fed giveth, the Fed taketh away. And right now, they take it away. But we are not yet entirely in the clear. Not yet, but it's starting to look awfully good for the bears. So start here. We have a potential for a top in place. And this doesn't look too good for 5 waves lower on a hourly or 65-minute candle time frame. But I can squeeze 5 waves in on a 5-minute time frame. That would be 1. And then this is 2. It just doesn't register on the hourly. 3, 4. and this is 5. And then we have A, B, C up, and now we're in this C wave, or third wave, 4 and 5. Okay, so if we can see a 4 and a 5, I'm totally in the camp that we have completed all of this wave 5 of a larger rally, and we're going to see a drop to the high 4,000s to start with. Potentially, this is the major top. We won't see this level anymore for the next decade or so. This is then the wave count, and pardon me, but we've been tracking this ending diagonal, and as you can see, it's all been ABCs. So to make 5 waves up fit, this green wave 4 low is set here. 1, 2, A, B, A, B, C, A, B, A, B, C, A, B, C, A, B. It's all ABCs. So that is why this is such a confusing, oscillating price pattern, and why it is still possible that we still can see a higher high, because as you can see, we have not broken below the ultimate warning levels. Okay, we have not yet done so, but it's starting to get awfully close. We're below the 20-day moving average. Already yesterday, we broke below this uptrend line that's been in place here since the beginning of the year. And then today we gapped above it. Was that a false breakout? Again, right? We had the false breakout a little bit earlier in March, and apparently it was not. So the pattern looks full. We always have had 53.50 plus or minus 50 as the ideal upside target. I think we got 52.64. Fine, that's good enough as well. And as you know, I've been warning throughout the last couple of days, like I said, over the last 100,000 days, that we're in this ending diagonal. Okay, that we've adjusted the bull warnings. Okay, that the bulls are walking a tightrope, they're playing with fire. So we got to watch all those levels. Okay, and I know that we've had this top pattern for a while now, which is frustrating. And also mentioned that we should not bank on this fifth wave, because the upside reward is small versus the downside risk. All of that stuff. Personally, my trading accounts are all all-time highs and looks much better. I've been trading primarily cryptos, GBTC, gold, silver, and a little bit in the indexes, but barely been touching the index. Gold, silver, oil have been great for me. The index is not so much, mostly been losing trades. Why? Because cash market has primarily been selling. If you bought the cash market at the open, you'd be down at the close. If you buy the cash market at the close, most of the time are up once it opens the next day. So the cash market's been selling, and cash is king. And when was it? I wanted to write actually that this looks like distribution. I think that was on Monday, but I have no proof for it, so I only want to state the facts. But it surely looked and smelled like distribution over the last couple of days to weeks. So this looks ugly. This is now our preferred wave count. Remember, for the Dow, our preferred wave count was for the top was in. Okay, that was our preferred wave count, and that the alternative was for a higher high. It's still possible. We'll have to wait and see. So the top is in versus there's still a wave 4. It is still possible, but I don't want to see it break below 51.35-ish. You see here, this is the third warning level. Okay, so we're getting awfully close. We're getting awfully close, and as you can see, that would be the third low here, third wave low, 4 and 5. Okay, so again, we're walking a tight rope. This looks ugly. So shorter term, it could still be a wave 4 and then a wave 5. Now we had at, let's see here, Tuesday's low, a nice possibility to reach 53.90. Then 1 would equal 3 would equal 5 at that low to 53.90. I'll show you that here. We had this potential. Okay, so all we do is of course show the potentials. So then we had this potential here. I'll show you that there. So at the low, as you can see here, we would reach perfectly 53, somewhere around 53.80, 53.90. So let me see there, and then this is the low. You see that? Would be picture perfect. Picture perfect. Picture perfect. You see how these arrows are exactly the same? Then 1 equals 3, and then 4 equals 5. So we had that potential, but it seems like the market giveth. It is still possible. as I showed you, it is still possible for this wave 4, but things need to turn around real quick. Okay. If anything, we'll probably just see 4 or 5 and then a bounce, etc., and start to move lower. So this is the only alternative that I have left. And then I don't think we're going to go to as high as 53.80s. We're probably going to stall if we see the same 5-1 relationship somewhere at 53 there, right? So we have this, and then we're going to stall there at 53.40. This is the only possibility I see left for the bulls. Once again, it's the only possibility. It would be tremendously ugly, and again, the pattern looks full. You see here how we counted this as A, B, C for a wave 4 versus wave 4 is here. Then this is a 1, 2. It's really, how do you interpret this price action? Now, this low here in mid-February on, for example, the NASDAQ was a 2, okay, not a 4. So it's all a little bit of how do you interpret this price action, especially since we're all dealing with only ABCs, which is nauseatingly difficult and frustrating. But this looks ugly. Now, again, we have not broken below all the key critical levels. So we still have this possibility for one higher high left to about 53.40. I'm not going to give it much more. It is still possible, but once again, trying to bet on it is going to be a tough one. Let's look at the monthly chart here, okay? I'm going to go over a lot of charts because there will be no update tomorrow, just to make sure we cover our bases. So we got this breakout. Are we just going to retest the breakout and move further? It is possible, but again, we have this nauseating negative divergence. And also remember, we'll show that in a minute, seasonality has a top due April 6th. So it's very close to have a top somewhere around today. Huh? It's very, very close. So this pattern, as you can see here for this diagonal, looks awfully a lot like the diagonal we've been sharing with you for the Dow Jones. 1, 2, 3, 4, 5. That would give us a move back to about, I would say, 36 to 37,000 on the Dow Jones before we see a wave 5. On the S&P 500, that would be a move back to about 4,700, somewhere around 4,700 plus or minus 100, somewhere around there, right? So you can see that here. Then we have, of course, strong support, of course, in this zone right there. Okay, and then we're probably going to touch that trend line somewhere around there. Okay, if we get this wave count similar to the Dow Jones, then this is 2, right? And this is 3, right? And then this is going to be 4, somewhere there, and then a final wave 5. I'll show you again how that could fit with seasonality. But please remember this nauseating negative divergence. And we've been mentioning that negative divergence for I don't know how long, and it finally kicked in, right? It finally kicked in. Now, moving on then to the Dow Jones alternative count is that we just got a irregular B wave high. Okay, that's it. And we're now in this C wave lower. Okay. How do we know the difference between, let's see, this wave count and this wave count? Well, we need to see, of course, a break, I would say below 35,000 to start to trigger this with confirmation below about 32,000. So this was our preferred wave count, and we have broken below this uptrend line. Okay, this starts to look bad. It really does start to look bad. So this would be like 1, 2, and then this 1, 2, 3, 4, 5, 3, 4, 5, something like that. The ideal upside target for this third wave in a ending diagonal is the 123.6% extension, which we had at 39,750. Well, we got awfully close, right? On the bigger picture, this is really, really good. We got to 39,950, somewhere around there. So this pattern looks full for the expanding ending diagonal. Looks really good. Everything is pointing lower. There have not been any buy signals for a while. And then the alternative is that we still can do something like a last wave up. But again, I'm not going to count on it because we broke below all the warning levels, right? We're right here on the cusp of this red warning. This just doesn't look too good. So I think we're going to head lower, which has been our preferred wave count now for Dow Jones for a last few days. So the NASDAQ also counts complete. Okay, 1, 2, 3, 4, 5. When I saved those three charts at around 2 p.m. Eastern time, I also had this alternative, trying to figure out that we had this wave 4 and then a 5. It is still possible. We're right here at this trend line, and this will then be an expanding and diagonal. Very possible. You see the difference here in wave count, 3, 4 versus 1, 2. It's a matter of interpretation. How do you interpret this price action? 1, 2, 3, 4, 5. This is 3, this is 4. And here we have 1, 2, 3, 4, 3, 4. See the difference? So it's still possible. But we've broken below all the warning levels, the blue, the gray, and the orange. Not all 3 of the 4. And the last one is here at about 15,900. So we're getting awfully close, and we close right here at this trend line. Things are looking bleak from a technical indicator perspective, and now as well from a simple moving average perspective. All the way up to Monday, we were well above all these moving averages, right? What does that mean? It means the market is 100% bullish. And now we're below them, so things start to look a little wobbly. Once again, does not look good. And as you can see how long it takes for the market before negative divergences start to finally matter. A long time. And still, you know, we're not really in a crash and burn environment yet. So here's the NASDAQ. And as you can see, oftentimes price stalls here at the third warning up. And it did it again. Now we're below the 50. This starts to look complete. Okay, from a Elliott wave perspective, I don't even know how to count this. This does look like topping pattern, very nauseating. And we should now be on our way to 50,900 plus minus 200. That's our preferred wave count. Why? That is this congestion zone here in November and the topping zone here in July last year. See this? So this is about right. And then a final fifth wave. That would be picture perfect. Match with, of course, the Dow Jones as well. This is the alternative 4 and another 5. But as you can see, we're really starting to break below these trend lines. So I'm not going to count on it. My preference is that we've stopped. This is the bigger picture. This is a trend line that connects the 2021 high with the 2000 high. And as you can see, we had a false breakout right now. So we might drop lower, again, back to about 15,900, 16,000, somewhere there, and then move higher. This is the yearly candlestick chart for the NASDAQ. And also here, we're looking then for this primary 4 and then a primary 5 to complete all of the bull market. And this would easily get us back to the 2021-22 lows, okay? Somewhere around there, or 22 lows, I believe it is, yes. Semiconductors, A, B, C. This is our preferred wave count. This has been our preferred wave count. And we continue to have it as our preferred wave count. As you can see, once again, price stalled on Monday, right here at the third warning level, right? That's the one of the most critical ones. If you go above it, it's often a given. You'll go to the last and final warning level. So I'm now looking here into the low 4,000s for this wave 3/C. 4 and then a 5. I prefer the 4-5 setup. Also based on the monthly candles. And this is 1, this is 2, this is 3, this is 4, and then a wave 5. Okay, that would be really nice. It's going to be the pattern we're looking for the technical indicators. It starts to look ugly, but I'm kind of missing a final fifth wave on the monthly time frame. So that's what we're going to look for. IWM, our preferred path was for this wave 5 top. So far, so good. This morning, I still thought, well, it can still trying to subdivide, but right now we have again closed below this uptrend line, below the 10 and the 20-day moving average. And I think the next order is to take out the 50-day moving average, take out about 199 to confirm this larger B wave top. Okay, so far so good. Again, shows you how nauseatingly overlapping diagonals are. 1, 2, 3, 4, 5. It's all ABCs. Very crazy price action. Don't like it, but it is what it is. So let's look then at some of the technical indicators. This is the bullish percent index for the NASDAQ. It's been negatively diverging here for a couple of months, but it can take a while before it finally matters, right? Divergence only divergence. It's not. Price is the final arbiter. And as you can see, history shows we can really truck along quite nicely with some pullbacks before it finally matters. But I think it's starting to matter right now. Let's look here at the new highs and lows for the S&P 500. Still no new all-time high in the new highs. Now we have to watch this for starting to move lower, just like we did here in 2007, just like we did here in the late 1990s. Meanwhile, the AD line has made a new all-time high. Finally, we've been watching this one for a long time, and it took, as you can see here, almost, boy, that is 1 year, yeah, more than 2 years to finally make a new all-time high. So this worry is off the table, because most bear markets start with divergences in the AD line, but we don't have to see divergences to get a massive crash. Okay, we don't have to. We can easily drop very hard without any divergence on the AD line. It's not a prerequisite. So here's then the summation index. There we go, highly negative, and this has been quite worrying here. This whole rally has been on weak breath. This whole rally, weak breath. So that suggests that it is a final fifth move. And as such, the summation index gave a sell signal already yesterday. Again, as you can see here, we've been moving higher, but the summation index, which adds the McClellan oscillator of today to that of yesterday, which was added to the day before, is negative, so, right? Less strength, less uptrend. This market has been rallying on 5 stocks and 5 stocks only. And of course, then last but not least, the PMO index has been tremendously ugly. The only clean, clear buy signal we got was here in January, and has been horrendous ever since. This one has not been working properly, right? You want to see a buy signal all the way to the upper end to about 100, and then a drop for an ideal sell signal. This has been very nauseating. This has already been keeping me on the edge, so to say. This has not been a confirmation to a full-on new blown bull market. Look here at the KST indicator, the known sure thing, I believe it's called. It's not looking too good, right? No sure thing. No confirmation whatsoever. So then last but not least, we're going to look here quickly at seasonality. Let's see if I can find it for you real quick. There we are, SeasonX, seasonality, I like it. And we're going to have a look here at the S&P 500, just to confirm what can we expect. So the last 96 years, so this is the general pattern, right? But we are in an election year, so let's just filter out all the elections here so we can compare apples to apples. Again, we had a top due based on average seasonality, April 6th. Yeah, it's April 4, close enough, right? These are all plus or minus a couple of days. And we should now be heading lower into May and then heading higher. So can we say wave 4, wave 5? Right, let's have a look if I can find it. Can we see here wave 4, wave 5? Can we see here wave 4, wave 5? Right, that's what we're looking for, wave 4, wave 5. It's possible. Nothing we're going to hang our hat on. This is, of course, just a general path, but this will give us almost 2 months of a decent bear market before we rally probably into the elections, somewhere into the summer, and then things will go haywire once again. Okay, that's kind of what we're looking for to complete this potential similar roadmap. All right, this is just an average. It is based on, of course, not 96 years, less, so divided by 4, it's about 20, 25 years of data, but it's pretty good. So far, it does look like we might have a top in place. Okay, and I've been warning about it for a long time that we are in this topping zone, right? But we have no yet confirmation, full-on confirmation just yet. Okay, but this is starting to look ugly. The Fed giveth, the Fed taketh. I think it's a safe bet to say that we're not going to see interest rates being lowered this year. And I think it's a safe bet to say that inflation is on the rise. I might be wrong. It's just a cocktail party topic. Price is the final arbiter. The bulls still have this one last rally potential left, but we're getting it awfully close, cutting it awfully close. We are walking on a tightrope and playing with fire. for sure, the fire is starting to escalate. Take care, trade safe, and I'll catch you all next week.